I'm Greg Hardy, and in today's video we're going to go over the pros and cons of a 15 and 30-year mortgage and what makes the most sense to get. We will compare the two and present the facts to better help you decide what makes the most sense for you and for your situation. And as an added bonus, we will also discuss adjustable rate mortgages. Oh, and while I'm thinking about it, I might as well ask that if you haven't already, that you please like and subscribe to this channel. Now let's get started. Before deciding on which mortgage to go with, you need to ask yourself what your timeline is. How long are you planning on being in the home? How much home can I afford? What do I want my payments to be? How much is my down payment? The more you can put down on a home, the better. I'd advocate for at least 10%, but 20% is better to avoid PMI. And we will discuss what PMI is a little bit later in this video. Also, make sure that your payment does not exceed 25 to 30% of your take-home pay. All of these questions can better help you decide which option is best for you. Based on which option you choose, you may have to adjust your expectations on what you want in a house. Let's start out with adjustable rate mortgages, or ARMs. As the name implies, adjustable means that your rate can fluctuate from year to year, either going up or down based on market rates. For example, a 3-1 ARM has a fixed introductory rate for the first 3 years of the mortgage, then switches to an adjustable rate for the remaining 27 years, adjusting yearly. These same options apply for 5, 7, or 10-year mortgages. ARMs often offer interest rates that can be as much as an entire point lower than the current 30-year fixed-rate mortgages. There is a per-year cap, meaning a rate can't increase multiple percentage points in a year, but it could go up, say, 1%. Then there's a cap for the life of the loan, meaning that if you started with a 6% rate, you wouldn't have a rate at 15% down the road. It may be capped at an increase of around 5% or so, giving you a max rate of 11%. Keep in mind, however, that this would nearly double your mortgage payment. Adjustable rate mortgages give some buyers the option to become homeowners in a market that may not be as accommodating otherwise. Unlike more traditional fixed rate mortgages, ARMs come with more fees and structures. ARMs also have the likelihood of being more volatile since the rates can fluctuate. If you elect to go this route, please do your homework and work with a lender that you can trust. So to recap, the pros of adjustable rate mortgages are low introductory rate, rate caps per year, and that rates could drop. On the flip side, the cons are the rates can rise, probably not the best option for long-term home ownership, and complex fees and structure. 30-year fixed rate mortgage. Let's start with the fixed rate part. Unlike the adjustable rate mortgage we just discussed, this fixed rate is permanent for the life of the loan. There's no guesswork as to what your payment will be each year. The most popular mortgage option is the traditional 30-year fixed rate mortgage. A 30-year fixed rate mortgage is just that. It's a mortgage that's structured to be paid in full in 30 years. Because a 30-year mortgage has a longer term, your monthly payments will be lower and your interest rate will be higher. You'll have a higher rate than on a 15-year mortgage, paying more in interest over the life of the loan. So the pros of a 30-year mortgage is you have more time to pay the loan back, your monthly payments are cheaper, your mortgage payment won't increase, and you have more flexibility. The cons, it'll take longer to pay it off, and you'll end up paying more in interest over the life of the loan. 15-year fixed rate mortgages. Just like the 30-year fixed, a 15-year fixed rate mortgage has an interest rate that's fixed, meaning that the interest rate will stay the same for the life of the loan. Since the loan term is half the length of a 30-year mortgage, it will cost you less in interest than other mortgage options over the life of the loan if you go the full loan term of 15 years. Keep in mind, the more money you're committing to your monthly mortgage payments, the less you'll have to invest in other areas. This depends on strictly what your financial goals are. So the pros of a 15-year mortgage are that you'll pay the loan off in half the time of a 30-year mortgage, and you'll have a lower interest rate. Cons are you're going to have higher payments and less flexibility. So let's look at what this looks like over the life of the loan on an amortization chart. The term amortization in real estate just refers to the process of paying off your mortgage loan with regular monthly payments. As you can see by this amortization chart, for a 30-year mortgage, it'll take 20 years for the amount of your principal payment to exceed the amount that you're paying in interest every year. With the 15-year amortization chart, That time is cut down to 5 years. Those are pretty eye-opening numbers, so let's take a look at them side by side. So in this comparison, it shows the difference in number of payments, difference in interest rates between the two, and the difference between monthly mortgage payment and total interest paid over the life of the loan. A difference of a whopping $264,000. Hopefully you can see the importance of paying off your mortgage quicker and the savings that it will provide. Unfortunately, your mortgage payment isn't the only money you'll pay when it comes to owning a home. Along with your mortgage payment that includes principal and interest, you'll have homeowners insurance and property taxes in your mortgage payment as well. So let's break that down a little bit. Principal is the amount that goes towards the loan amount. Interest is the money the lender charges you to have the mortgage. Homeowners insurance is what protects you from losses and damages to your home, along with the furnishings and other assets in the home. Homeowners insurance also provides liability coverage against accidents in the home or on the property. Property taxes is the tax that you pay to own real estate to your local government. If you put down less than 20%, you'll be charged with private mortgage insurance, also known as PMI. PMI protects the lender, not you, if you stop making payments on your loan. The amount you pay in PMI depends on the size of your loan and your down payment, whether it's fixed or adjustable rate mortgage, and your credit score. No matter which mortgage you decide on, the payment shouldn't be any more than 25 to 30% of your take-home pay. I'm talking total payment, principal and interest, taxes and insurance, and PMI. Buying a home is a wonderful privilege and a dream for most. But by having payments north of 30%, you run the risk of being house poor, and the dream of homeownership can turn into a nightmare. Now, I've personally had both a 15 and a 30-year mortgage. We had a 30-year mortgage on our primary home, and then after a couple of years and a great rate, we refinanced down to a 15-year. The flexibility that we had with a 30-year mortgage allowed us to put more towards the principal loan amount if we wanted to. Ultimately, we ended up paying off our home in 4.5 years. On our rental properties, we always went with a 30-year mortgage. It kept the payments lower, which gave us more cash flow. We then took the extra cash flow and applied it to the mortgages, and we paid them off in an average of 2.5 years. If y'all would like, I would be more than happy to do a separate video on that. Just comment below. For all the Dave Ramsey followers, I know he recommends the 15-year mortgage. You could always buy a home where you could afford the 15-year mortgage, but take advantage of the 30-year. You could even make what would be the 15-year payment on the 30-year mortgage. Plus, if you get a tax return, a bonus at work, or some other extra income, you can apply it to the mortgage too. Just one extra principal payment to your mortgage a year will reduce your mortgage by a few years. I know I've said it before, but keep your total payment at or below 25 to 30% of your take-home pay. So now that we've compared adjustable rate mortgages, 15 and 30-year fixed rate mortgages, I wanted to summarize. And I'll be honest, in my experience, adjustable rate mortgages are very risky and unpredictable. Not to mention that your mortgage payments can also increase, and in some cases dramatically over the term length that you've selected. Over the long term, you will save more money with a 15-year mortgage if you go the full loan term. Your total interest cost and total amount paid will be lower. Short term, however, you save money on a monthly payment by choosing the 30-year mortgage. Taking out a 30-year mortgage but treating it like a 15-year mortgage takes discipline, but can be very rewarding. It can provide you with more flexibility in your budget, especially during those months when unexpected expenses arise. If you decide to make extra payments, make sure to apply those funds directly to the principal balance only. By taking a close look at your monthly budget and whatever other financial commitments you may have, it can help you determine what kind of mortgage payment will be best for you. For all the real estate investors out there, cash flow is king, so getting your payments as low as possible is what you want. When I financed rental properties, I always took out a 30-year mortgage to give myself as much flexibility and cash flow as possible. At the end of the day, you want your investment properties to be as profitable as possible. Guys, I really hope you liked this video and that you got something out of it. My goal is to be able to provide you all with informative content that you can use to increase your wealth and financial knowledge. I would also like to encourage you to watch more videos on this channel. And if you haven't already, please like and subscribe. It means a lot. Thanks for watching.